Greetings, Dr. Jeffrey Scott here, and this is my weekend market update for the weekend of Sunday, January 7th, 2024. This weekend I actually went to what I would consider continuing education for my trading world. I went to a meeting for VectorVest. They have it every year, the first weekend after the first in Tampa, so I can drive to it. It's really low cost, like $195, and they feed you. And it's an interesting meeting. And when I walked to it, I was driving home today, I thought, I spend all my time looking at charts, especially stocks, and scanning stocks and trying to figure out which are near breakouts, which breakouts are going to hold. And what you take home from that meeting is that you buy the best stocks in the market when the market's going up, and you short the worst stocks when the market's going down. And it's so simple in that much of their approach, although they do more charts today than they did in the past, is really scanning the market, and they have their own proprietary tools. And you scan for stocks that meet certain criteria, both fundamental and technical. And you can do all kinds of back testing where you have the ability to build portfolios and watch what happens over time. And darn, it sort of shoots the whole idea of stock picking and looking at charts because it actually is pretty interesting. Now, I'm not giving up on what I do. I've been a fan of theirs for a long time. It's a different approach. But the part of the approach that I like the best is I'll take responsibility for figuring out what the best stocks are at a given moment, but they really reinforce what I believe, which is it's the wind at your back. A bull market is when you make most of that money to the long side, and that in a tough market, and we're starting to be in a tough market, you have to be careful to the long side. So let's talk about what we usually talk about. I call this Santa delivered the markets a lump of coal. If you think about it, the Santa rally, I think it's the last 5 days of the year, so it would have been the prior Friday, then Monday, then Tuesday, Wednesday, Thursday, Friday before the first, and then it would have been Tuesday and Wednesday afterwards. And you could see here what happened, and this was KFIN published this, and you could see how, by and large, the U.S. markets, the industrials were up 0.06%, but the spiders were down a little bit over 1. RSP, the equal weight spiders, almost 1. The Qs were down 2.4, mid caps 2.8, and small caps 3.6. So no Santa rally this year, although it started a little bit promising. This is for educational purposes only. Anything I talk about should be taken in the spirit of education and not be considered investment advice. I'm a doctor, not a broker. I'm independent of any software vendor, so I can talk about whatever tools I like, whatever I use, and nobody pays me anything to talk about their specific products. And trading involves risk, and you are solely responsible for any investment decisions you make. From time to time, people ask me, can I manage their money? Can I let them copy my trades? And the reality is, I have a very important license to me. It's an MD. I don't have any of the licenses that would give me the ability to manage somebody else's money. So this is what it is. It's purely education. And one of the challenges with any of these videos that you watch is there's a lot of people that are really good at picking great stocks, but they don't always tell you when they sell them. So again, take this as education, the approach to trading, how I look at the markets, and do your own work. And I think, it's something that Ian Woodward, probably the most important mentor I've had, used to say is he's not a guru, and his job is to help teach you to become your own guru. And that's how I look at these. It's to help you be a self-directed trader. Now, there is another great continuing education event coming up, and it's January 15th through the 20th, and that's the Wealth 365 event. Starts a week from Monday. I am speaking late morning on Friday, which I think is the 19th, and look forward to talking about how I approach the market. Um, Hope to see you there, and I'll put the link for registration in the remarks section of YouTube, and appreciate it. I always appreciate it if somebody goes and registers on my link. I don't get anything for it, but it's kind of amazing. I'm just a amateur guy who likes talking about the market. I don't have a website per se. I don't sell things on a website on a regular basis, and I don't have a mailing list, but they keep inviting me back, which I'm pretty excited about. If you like these videos and you want something shorter on a daily basis, check out stocksanddocs.com. This one they'll ask you, you can skip it, to put your name and your email address in, and that way you'll get notice when I place them. I try and do them every morning, but reality is that means about 2 out of 3 mornings I get to it. So, going back to what I said in the beginning about, excuse me, the market really determines what's going to happen this week, not how good of a stock picker I am. The market's not the same market as it was 2 weeks ago. I think you know that if you're in the markets. So, whoops, sorry about that, I hit the mouse. So I added a column here which is a percent change on the week. And the reason I added that is because it was a 4-day week, and HGSI, where I basically take this from one of their views, looks at a 5-day window. So if you look at the major markets, the Dow over the 5 days was down 0.59%. The NYSE is down 0.56. The S&P was down 1.5%. NASDAQ, the Qs were down 3%. The NASDAQ Composite 3.2. The Russell 3.72. Now the markets had run a lot. There really is a question, is this just going to be a short-term pullback and then we go on to new highs? Is this something worse? And right off the bat, I'll tell you that my feelings we're probably going to go a little bit lower here, but I don't get the sense that this is a market implosion. I think we pulled some of January's returns into the back half of December. The rally off the last 4 or 5 weeks of the year was pretty impressive. And you could see on Friday there was some green when we look at the performance. What else can I show you? I can show you that if you look at the Dow and you look at how it compares to a 52-week high, it's right there. The NYSE is right there. The S&P 500 is now 2% away. NASDAQ's 3.9 or 4%, depending on what you look at, and the Russell's 6%. So none of the major indices are that far from all-time highs or 52-week highs as it may be on the Russell. So hard to be depressed here, in my opinion. You could see on the sectors, if you look over the 5-day period, it was pretty mixed, green and red. All right, so let's continue on. This is the Q-Edge tool, and this does tell a story. The first story it tells you is we went from 85% or higher of the stocks in the S&P 1500 being above their midline. We've now dropped to 41%. So that's been a massive breadth contraction. If we look at Friday, you can see a third of the sectors were up, almost half of the industries were up, and half the stocks. I call that almost a 50-50 day. If you look out over a month, you could see how strong the market's been, even with the last week. Over the month, all the sectors are up, 84% of the industry groups are up, and 78% of the stocks are up. So that's a super, super strong market. But you could see deterioration when you look at 10 days, 5 days, 2 days, and then a little bit better on Friday. So the question is, how much further do we have? And we'll take a look at some of the tools that might give us some insight. This is another Q-Edge, Q market breadth tool. And the point I wanted to make is to show you how We still got a lot of stocks above the 50. We still have a lot of stocks above the 200. And we still have a rising number of stocks whose 50 is above the 200. So even though we've had a little bit of pullback, we haven't had a massive uh, change to the market. New highs, new lows, and AD volume, advanced decliners, all deteriorated this week. If we look at down here, you could see that this line here, which is the 13-week new high, new low, this is a composite of the NYSE and the NASDAQ, has started to pull back. And what you could see from mid-November until recently, this light blue was in an uptrend, which meant that small caps were starting to outperform. And then the other thing that we're still seeing here is that we're starting to see value outperforming growth. So small cap value actually has been outperforming. Now, it all deteriorated at the end of the week. And then if we look at the various indexes that we're familiar with, you could see the deterioration in the S&P 1500 breadth. And then in the small cap 2000, if you look at the 13-week new high, new low, you could see a pretty massive deterioration there. This is the Nick Drendel tool. Again, one of the heads-up displays that I like because it gives me a sense of what's going on in the market. You could see that on Friday was a relatively nothing day. Even ARKK was relatively flat. You could see it finished in the lower third or so of the trading range. If we look at one-day performance versus 5, you could see over 5 days, healthcare has been up 2% and energy 0.8. Everything else was negative, led to the downside by solar, China, and some of the crypto stocks, the blockchain. If you look at what happened on Friday, most of the things in the market were up. The other thing, and I'll talk about it later again, is we're seeing a little bit of deterioration, at least for Friday, on the new highs and new lows, whether we look at 1 month, 3, 6, or wherever. So that will be something to watch. Now, underneath, in white, you can see the rates on the 10-year, the rates on the 30-year ticked up, while the S&P ticked down. That was probably because of some hot numbers, especially on unemployment. I still am in the no recession camp anytime soon, probably after the inauguration in 25 if I was a betting person. But if you look at the 10-3 and the 10-2, you could see that they are well below the zero line. And if you notice, the gray band of recessions occurs every time after they resolve the inversion. Well, we haven't resolved the inversion. In fact, on the 10-2, we're nowhere close, or 10-3 rather. Something that would argue against recession is this Bank of America High Yield Index Option Adjusted Spread. And this is a way to look at how tight the money supply is. And if the market was in trouble, if the economy was in trouble, I'd expect to see a spike as it has during recessions. We're not seeing that. And this is the Philadelphia Fed Diffusion Index. And the recessions usually resolve as we get above this 0.2 line, or minus 20 line. And we are above and have been above the minus 20 line. So I think you have pro on the top, con on the bottom about a recession. But I like data, and the data says when you get the inversion, you get a recession, but it occurs after that's improved. And how are we going to fix that yield curve inversion? Well, if the yield curve inversion is because the rates, the 2-year is higher than the 10-year, the only ways you can fix it are for the 10-year to get higher, which isn't a good thing for the economy necessarily, or the 2-year to get lower. Well, there's a double-edged sword there. How does the 2-year get lower? The Fed has to cut. Why does the Fed cut? Because the economy is bad. Breadth weakens. You can see a little bit of tip down stocks above the 200, a little bit more of stocks above the 40, and I showed you the new high, new low. And like clockwork, when we get up to this line here on the 13-week new high, new lows, the market always pulls back. It doesn't crash. It doesn't mean it's going to crash. It just means it's going to either consolidate, pull back a small amount before it runs again. Now, of course, boy, I got to stop that. If you go back here to 2023, the market did pull back pretty hard. Current buckets, wow, isn't that a bell-shaped curve if you ever saw one? It's a neutral picture, as neutral as it gets. In fact, more stocks are below the midline. Total resolution of the buckets showing us that the markets were extended. If you think about it, we've improved a lot of our extended markets just through rotation without any massive hit to the major indices. Hindenburg-Omen, I would say that I don't expect to see a Hindenburg-Omen anytime soon, but interestingly, 3 of the 4 signals hit on Friday in the NASDAQ. What I am seeing, and this is good, oh, come on, Jeffrey. Sorry about this. So touchy tonight. I'm going to have to get a different mouse setting. Is that the number of new highs and new lows on the NASDAQ. Unfortunately, the new highs are low, but fortunately, the new lows are very low. And on the NYSE, the new highs have come in. There's still not many new lows. So it's hard for me to believe this market is going to be tanking without seeing some of those new lows pop up. When you look at the market through some of the lenses, looking at the data from last Friday and asking how did that impact on market return over the week, on the left you could see that pretty much across the board, and we ignore this because there's not many stocks here, pretty much across the board the market was relatively flat but below zero, so losing. When you look at how earnings per share impacted actually stocks with the best earnings rank, did worse. Stocks with the best relative strength did worse. And the best performance were in the stocks that were distributing a week ago. So that tells me that, hey, market's rotating. And if you look over here, you could see the majority of the different groups that I follow, not everybody had stocks in it, were to the downside. Now, some of those downside will be like my shorting candidates, which were down 4.24%. Well, you want shorts to be down. But you'll also see things there like the IBD weekend review, which is the 85.85, which I saw a second ago, which was down 3.86. The IBD 50, which was down 3.53. So growth didn't work. Even the Magnificent 8 was down 2.5%. Pullbacks waiting for a signal is one of my favorite trades. Was up a little bit, 1.85. My buy watch was up 1.5. And yeah, I was actually positive on the week, but it was a push because I had more stocks were down than were up. I bought some SQQQ as insurance, and that protected my portfolio. Know your news and your earnings. I was thinking maybe we get a quiet week after last week, but no, we've got Fed head on Wednesday. And Thursday we got jobless claims and CPI, and Friday we got PPI. And we're starting earnings season. So you'll see on Friday before the open, you're going to see Wells Fargo, JP Morgan, so you're going to get Bank of America, and then BNY, BlackRock. So you'll get a sense of the status of some of the financial, both the stocks and services companies. And they are doing really well in the market right now. Delta should be interesting really over the week. As the week went on, some of the strength started to turn into the airline stocks. So losses falling 9 straight weeks of gains, no surprise. Profit taking in the big caps. Other stocks that outperformed last year also saw profit taking. Markets are rotating. Again, things that held up better this week were things that underperformed in the prior year, whether it's the Russell growth, whether it was utilities, healthcare, and staples. So far, to me, the pullback seems fairly orderly, and the major indices, for the most part, are within 5 to 6% of their all-time highs. My weekly timing model is still long. The daily one's gone to a sell, so I'm going to introduce that today. It's something I'm hesitant to usually show. but I'm also hesitant in this scenario to add to my longs. I mentioned the SQQQ, but some of the things, especially the leading industry groups of healthcare, biotech, and then one of my specialty pharma stocks, TGTX, really had great weeks. And the Fed's going to be pressured if the economic data, including employment, beats to the upside in the setting, perhaps the exuberant market expectations for the beginning of, so when and how many rate cuts. And I think that's the danger right now. If, the employment figures came out strong this past week, that didn't help the market. What happens if we start to exceed expectations on employment, if we see a pop in inflation? You're going to immediately see an end to the pivot and either more rate hikes or talking down rate cuts. And the market's already pricing in a lot more cuts than the Fed thinks they're going to do. So we'll see who's smarter. Again, January 15th to 20, the Wealth 365. I mean, I love the program. I love that event. I found the program when I was just like all of you, signed up, went to the program, bought the program, talked to Rob, got my stuff into the program, and now I actually get to participate in the program, as we mentioned. So let's go on to the charts. Let me end that. All right, so this is my weekly timing model. So those who follow me for any length of time know that in my model, two things have to occur. You have to be above the WMA 30 period, and your bongo has to be green. The weekly is my go-to. Why? Because notice the weekly got you in March, and it would have kept you in until September. It would have got you back in November 6th, and you'd still be long. Well, you would have done quite well in the market if you followed that. Same thing, similar thing on the Qs. So I've used this for a long time. Now, the model has not, it's been long, the Russell, ever since November 27th. I guess actually since November 20th when I look at that bar. So it's been on the right side there as well. So right now, what are we seeing? We're seeing little topping patterns, pauses to refresh, some consolidation, but none of them have broken. The Russell's interesting because the Russell has been a tale of two boxes. I mean, the Russell was clearly in a Darvas box going into the high of 2021 until breaking out of that box in April 2022. And this was a false break to the upside. And I've learned over the years when something acts like it's going one way and then it fakes you out, it's usually a big move to the opposite side. Now we've been in another box, really from that period, April 2022, and we thought we got out of the box, but we're still in that box. So that bothers me, to be honest. I'd really like to see us get out of that box. And then here the diamonds are super strong, as you can see. Now, I don't always talk about my daily signals, but I wanted to mention them now. And let's make sure that we are, all right, so that's set it weekly. So let's make this daily. Perfect. And you could see on the daily, all except for the diamonds, they're no longer in buys. We've broken down on the spider, on the Qs, and the Russell. So how do I analyze that? Well, to me, it gives me fairly objective evidence that the market's deteriorated. The fact that the weekly is holding up tells me we haven't broken down. So right now we're in a short-term orderly correction. But as long as that daily is sitting there in a sell signal, I don't feel the need to go out and find lots of long positions. Doesn't mean I can't buy anything. Doesn't mean I'm going to short the market because that would be counter trend trading because the market is still going up on the weekly. But it's enough to give me pause, and it will give me an earlier signal to get back in perhaps than before the weekly changes. And just look at, again, the timing. It would have got you in November 2nd. It would have got you out January 3rd. It would have got you in on November 2nd. It would have gotten you out here, which was January 3rd. It would have gotten you potentially whipsawed a little bit, but if you entered on this bar, you don't exit until you are below and the bongo goes red. So on the Russell would have got you in November 2nd and would have got you out January 3rd. And if you look at the diamonds, it would have got you in November 2nd and you'd still be in it. So it is effective. Um, it's fast, and I like the weekly as well. So I use them both, and I thought I would show you that today. All right, let's take a look at the markets. We look at the 5 minutes of the spiders, and the spiders is not the market, and maybe I should be looking at like the S&P 1500. But my goodness, we gapped down at the open. Remember, we didn't have market on Monday, and we've had little gyrations, but we pretty much have headed down the entire week. That is not a bullish looking week in the markets. If we look at the daily charts, the spider, as you can see, had a little bottoming tail, bigger topping tail, kind of a doji. Now, very easily that could be a pause here, a indecision, and we could go higher. And this might just turn out to be another flag. And that's kind of what I think is happening. But I mean, short term, I don't know what it's going to do over the next couple of days. It may head down further, which is probably likely. The Qs, a similar pattern with the doji. The diamonds with the doji. So to me, the doji is a reversal, it's a indecision candle. And the way the market trades on Monday is probably the direction it's going to go, at least for the short term, which seems very self-fulfilling after I said it. The Russell has dropped down below its recent highs. Also had a doji with a big topping tail. If we look at the VIX, let's see if that gives us the final one we want. That's the 4th, so it's not even Friday. So if you look at UVXY, you can see that UVXY was down 5%. So if the market is so horrible, why are these holding up? And if we look at, let's just take the UVXY and look at a weekly bar. First I have to find it. It was relatively flat on the week. And lastly, the dollar is in the midst of a big gap down sell-off, and it's really consolidating after the gap, kind of at the place it gapped from, which kind of looks like it's turned into some resistance here. If we look at commodities, gold and silver tried to do something on Friday, but they both finished with small gains, but much, lower than their highs of the day. Oil is stuck below this 200. Natural gas is trying to make a move off of a very low level. And the 10-year traded up to the 200, and look what it has. It has a doji as well. And that's interesting because as I think about, I guess we can just use the date November 2nd to the end of the year. That rally was driven by weak dollar, weak 10-year, and weak oil. We still got all three of them, but the dollar looks like it's gaining footing, and the 10-year's testing resistance. If we look at some of the breadth, we have seen, as you can see by this curve here and this curve here, broadening out of the markets, where in the center pane, the RSP, which is the equal weight S&P 500, is outperforming the cap weight, which we did not see in 2023. What you're also seeing is of late, the equal weight Qs are outperforming the cap weight Qs. If we look at the sectors, the big winner is and has been financials. It was last week. But look what XLV has done. XLV was in the toilet, and I saw that with so many different medical stocks showing up on my scans. Not a surprise. It's kind of a defensive thing. So is staples, utilities, and REITs, which are also come up. Discretionaries come down, as has technology, and industrials and materials also look interesting. Biotech, which led up long before XLV was up, is still strong, although it gave up some. And Biotech, I mean, we started talking about LABU when it was about $3 to $4. It had a 20 to 1 split, which meant it was $60, $60 to $70. And it ran up to almost 130. So biotech in a very short period, as we talked about before it ran, has had a very nice move. Now, the strength of wealth charts in my book is the scanner. And one of the things I love about the Wealth 365 event is I get exposed to a lot of different people's stuff, and I can buy, just like you can buy at the same price, and accumulate different scanners to help me find stocks that are working. Well, I have a scanner there. It's called the CAT scanner. First thing I like looking at, and this is Friday on the S&P 500, and you could see Friday wasn't a bad looking day. Mixed, Tesla, Apple, and this includes the after hours session, which is short on Fridays. But you could see a lot of green, even though on the day it was a relatively flat market. If we look at Wealth Scanner, we've definitely seen damage. If we went a week or two ago, we'd see 830s and 850s the entire way. And as you could see here, the only things at 800 above are pharma and healthcare. And you saw the strength in the healthcare versus the spider. As we go down this minimal volatility, whatever that is, here's another pharma. Insurance, that's kind of defensive. Indonesia, MLPs and energies, we talked about them moving even last week. And now we start dropping considerably. So this just tells me where the strength is, healthcare, especially pharma, but it's also showing me how much deterioration we've had in the market. If we look at my CAT scanner, this is how I really sort things out. So if we just look at biotech and pharma, I like to rank things different ways, and my indicators are coded into the program, and the scanner allows me to search for specific patterns. Now, in normal markets, and I don't think we're in a normal market, I like pullbacks and uptrends. Well, the challenge here is things are way off the bottom, so pullbacks and uptrends might be good, but maybe nobody's pulling back. So these are the pharma and biotechs that are pullbacks and uptrends. So Jazz. Now, Jazz is a company that's got things for narcolepsy, some things for cancer. I look at the chart and I see, yes, some short-term strength. I would pass on this because it's failed multiple times at the 200, and until it broke above the 200, I'm not interested. That said, it had a breakout and momentum signal on Friday from a squeeze. It's had a recent PSAR reversal, a red candle low. The weekly bongo just flipped to green. It's not extended. The number is 22. Above 95, it's extended. And the relative strength is broken out, and OBV is strong. So it's worth looking at, and if it breaks above the 200, maybe goes sideways for a couple days, retest there, I might be interested. I am in the next two stocks. TGTX is a stock that's remaking itself, or a company that's remaking itself. It had a cancer drug which came to market. It is being pulled because, or was pulled, the side effects. But it turns out the same drug potentially works in, I believe, multiple sclerosis. Now, the good news is you use very small doses compared to the cancer dose, and the horrible toxicity is not there. And the better news is the pricing power is about 50 to 1. So even though cancer drugs are expensive, drugs for MS, you have a lot of pricing power. So with data, here was a day that had a nice data release, big volume, a breakout. This was a time to start thinking about the stock. It was not at all in an uptrend. The weekly bongo was still red. Recently pulled back and is running again. And you can see relative strength in OBV. It's now broken above the 200, which is exactly what I want to see Bausch & Lombs do. Break around it, go sideways, and then break out from there. And so I like TGTX, and I am long that. I've been long Axosome, waiting for it to get bought. I sold a bunch of it and got back in, but you could see here it broke above the 200. It's in a nice little uptrend. Um, it's got marketed products. Novartis is big pharma, and big pharma was dead for a long time, but you could look at many of them, Lilly, Novo, BMS, Pfizer. They've all started to move, and many of them pay dividends. I don't know Sana Biotech, but it's had a nice little breakout here above the 200. It's a cheap stock. And Takeda is a Japanese conglomerate that owns a pharma biotech company, and I don't like it because it's so far below the 200. So that's biotech and pharma looking at pullbacks and uptrends. Now, we've been going for a long time, so another thing I like to look at I call our rockets. And I forgot to look at BHC, but we're going to look at it now. So rockets will be stocks that are in a weekly bullish, a daily bullish with not requiring a recent pullback, and I'm looking for dots. So Bausch and Lomb's, it's kind of ugly because it's really a stock that's been beaten down, but this is exactly what I want to see. It broke above the 200 on decent volume, breakout momentum coming out of a squeeze. All the bongos are green. Relative strength and OBV looks good, so I like Bausch and Lomb's. BioNTech, this is one of the like Moderna vaccine companies. This looks interesting here, something I'll be watching. Shattuck Labs, this was a big mover last week. I don't know enough about to tell you, but it's starting to get extended. Here's their TGTX. Cytokinetics is another one. I think this gapped up on data. 94, 108, and then downgrades to 90. So this one's getting kind of expensive. MRNS is another biotech stock, and you can see this is what biotech did. November and December, these things ran. This one's pulling back, getting ready to go. So another way to look for is rockets. I have one that looks at momentum, and all I care about is that the stocks have the dots. And AbbVie is one that's interesting. It had bad news one day, but it's hard to see it on the chart. And this thing we talked about last week is in a power move, and it pays a nice dividend. But my favorite go-to is always the pullbacks in uptrends. Bottom poppers would look for things that are beaten up, that are starting to move. In fact, most of them, their Bongo Weekly is red because they've been in a downtrend. So ARGX, we're not even going to talk about those stocks today. Let's go back to my pullbacks and uptrends. And let's look at a broader list. Let's look at my combo list. For those that are new, this is a curated list that I put together each week. And this is where I fish from. And for the most part, this list is from scans in TradeStation that are my own, scans in Wealth Charts, scans in Thinkorswim, and then published lists from things that I purchase, whether it's Investors Business Daily, MarketSmith, others that are published on the web or given out freely on the web. I combine that list, and that's where I fish from. So we rank them by dots, and let's take a look at a couple. So remember my favorite trade. So here's AMCR. This is one that I was in. It had a nice move, and then it sort of had a reversal here, and I was no longer in it. I'd like to see this break above the 200 before I get excited, but big volume, breakout momentum in a squeeze. Bongos look good. Relative strength and OBV look great, not extended. Break above the 200, I find that interesting. One of the sources of strength this week, and it's probably tied to what's going on in the Red Sea, was shippers. In fact, a lot of shippers made my scans. And many of these shippers have really impressive dividends. So this here is DHT Holdings. So if you look on the right, the weekly chart, it's kind of loosey-goosey, but definitely it's in an uptrend. Recent pullback on the weekly as well. And here we had a breakout above the 50, an EMS, volume, breakout momentum, relative strength, and OBV are strong and not extended. I like DHT. And Compass Health is I think they're mental health facilities. It's in a nice uptrend here. We talked earlier about the strength in healthcare. Frontier, or Frontline rather, is another one of these shippers that's breaking out. International Paper. I would think this is an economically sensitive stock, and what a beautiful move. A big run up, sideways consolidation, and then on very big volume Friday, not a super strong day in the market. This thing broke out above the 17. Got to like that one. Um, NU Holdings is another one, and you could see up, sideways, and then a big breakout here on volume. So I hope you see this is rinse, wash, and repeat. I look for my favorite pattern, and I scan for it in a enriched watch list, and then I build out my trades. Let me talk a few comments about my trades. Again, this is for educational purposes only. And remember, the only licenses I have would allow me to practice medicine. It won't allow me to tell you how to manage your money. Let's look at TGTX. I really like this here. And I know it looks like it's extended because it's had a huge run, but mathematically it's not extended because it just took out the 200-day moving average. I also know that this stock was the $35 stock going back in May of 2023. I think this is an acquisition candidate like Immunogen that I gave you. I think that this neurodegenerative approach to treatment gives it the pricing power and a market. So let's say I wanted to play TGTX. And I just want to show you a couple things that are important to me. Everybody who knows me knows that I actually work for a living. So I am not going to be able to be around to decide to take the trade on Monday. And there are reasons why I might not take this trade, but let's just set this up. If we look at Friday, the close was 1980. The high was 1980, the close was 1965. I think what I'd like to do is set a buy at 1985. Why would I set my buy watch there? Because if I'm at work and I have a large healthcare technology company with 3,000 employees, so I'm not watching the markets all day. 3 or 4 things can happen on Monday. One thing that can happen is it gets bought out, it has a candle like that, and then it's going to be, or it has news, and that's going to be a coulda, woulda, shoulda. Boy, I wish I bought it Friday before, and I already own it, but I wish I bought it on Friday. I won't get filled there. I have a buy stop, limit stop set here. So that doesn't hurt me. It pisses me off because I should have got into it on Thursday, but that doesn't hurt me. Or I could get one of these. Market opens up here, closes like this. Maybe the market trades down, trades up. There's all kinds of things the market could do. I only want to get filled if the market does this. All right, so by having a buy stop here, the instrument has to go up for me to get filled. So I'm sitting at work, minding my own business, not watching my stocks, and I know that there's only one way I'm going to get hurt on this. And I'm going to get hurt on this if the stock opens up, go back to the freehand, it opens up here and trades up on the day, and then closes down here. And there's not a darn thing I can do about that except I'm going to put a stop probably, and I'm not going to give away all my secrets, but I'm going to have a stop in the market probably down here somewhere. Now, I don't know if I can handle that stop because that's way too far away. So I would look and probably place my stop no lower than 1762 and probably might even bring it up here. I don't want to be more than 8% away. So 8% there's a dollar, say $1.50. So 18.15. All right, I might set it here, sort of an area that was resistance. So now here's what happens. The market opens up, stock trades higher, I get filled, it closes higher on the day, hip hip hooray. Market sucks on Monday because of a news event and everything breaks down. Oh well, I'm in cash, I don't care, I've got a lot of cash, I'm not all in cash. I don't get filled, perfect, I can reevaluate at a lower price. Worst case scenario, I get filled and then the market breaks down. That's why I have a stop in. So I put in a limit order to buy it, and I typically buy when it takes out a few pennies above the high of the day that gave me the signal. The minute my limit order is filled, a conditional order gets placed, which is if the stock does this, get me out. And now it's on autopilot. And then I have a stop management system of how I raise the stop and take profits out so I can protect myself. Because the other thing, I've learned a lot of things in 30 years of trading. And the glory and the excitement is, is when you have a stock like Immunogen. And anybody watched me long enough knows we talked about this as a stock likely to get bought. And you wake up and the stock is sitting at 29, and when you went to sleep it was at 15. That's a happy day, and I know many of you had that happy day with me. That doesn't happen all the time. Those are great, but the most important thing is you don't want to have one of these stocks that craters. And biotech is an element that likes to crater because of news, but it's also one that likes to do what this did because of takeouts. I've been talking a long time. You're probably tired of me talking. Let me just take a look if there's anything else in my buy watch that I thought was interesting enough to talk about it. So I always create a buy watch over the weekend after looking at about 1,000 stocks and running my scans. And then I'll pick a few of these and I'll use them to be potential trades. When you look at this, and actually let's go through the watch list side so I'm not limiting it by signals. Not all of them are buyable here. It's a watch list. It's not a buy list. But we have a number of healthcare stocks. Axogen is another. This is a cheapie of that same pattern. Now, this one's actually showing that it's extended. I could probably deal with that with this pattern. Bank of America, the bank stocks, now earnings are coming out, but you go back here, which was October 27th, and look at the run that Bank of America has had. Bausch & Lomb's is one of these cheaper biotechs, old name breaking out. Never mind. This is what a leader looks like. This is FTAI, big move higher. Look at the weekly chart. I look for places to add. I don't see one right here. It's pulling back. But by having it on my watch list, I'll be looking at it routinely. I mentioned Delta has earnings this week. This pattern of a reversal occurred in a number of the airline stocks. This one was unique because it's above the 200-day moving average. Ironwood is another running a little bit of a flag here. I'm going to be looking for a breakout above the flag. Lilly we've talked about a lot, the Mounjaro King. And you could see, well, which all you ought to see here is what it's done on the weekly. And Many of my friends have been in it since about $300 because we talked about it. LPG is another shipper. Probably the best stock of our lifetime is going to be NVIDIA. If you look at the earnings on this stock, and if the multiple comes down, I didn't say goes higher, but it meets its earnings projections, this is probably a $1,000 stock in 2 years. I believe it. I think this is the stock that you accumulate on weakness, and probably if we get a nice washout in the market, I'll be adding to my NVIDIA. NVO is a company that has the Wegovy and Ozempic, similar to Lilly's Mounjaro. So there's a lot of pretty charts. A lot of pretty charts. RELX, it's an ADS, so it's a foreign stock, but high relative strength. You're buying it at highs, unlike most other things we looked at. One that I made money in a while ago, SMCI, it's just gone sideways. But when you look at the earnings are going to start to grow. And this is another one of the equipment stocks that would be supporting the AI. TNK is another tanker. Again, this is a leading group right now. And I think that's probably enough to look at. So I gave you a lot of stocks. I talked a little bit about my philosophy of trading. But I want to just remind you of this. To reverse the daily signals, it's not very tough. I will be watching my timing model on the dailies, looking for it's all clear to go back in. Just the way the model is and the time it takes for a weekly bar to close, I'm going to see all clear on the dailies before the weekly starts going higher. So the weekly, let me change this back to weekly. In fact, I now know what my problem is. Let me make these green. Oh, I don't want the symbol to be green. Jeffrey, I want the time to be green. Green and green. Let's change this to weekly. Hasn't broken down. It's still in a buy. I just don't like the current pattern. With the daily on sells, I think being prudent with your money and being careful short term makes sense. Watch the charts. Good luck with your trading. And I hope to see you at the Wealth 365 event. And thanks for coming.